Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule, Chairman of Sprott U.S. Holdings. Thanks so much for joining me today.
Always a pleasure, Charlotte. Thank you.
Great. So I wanted to start out by talking about your recent CNBC interview, which I watched. One thing you said during that was the gold price could rise if the anticipated U.S. interest rate fails, or if Janet Yellen isn't able to follow through with a second interest rate rise. I'm just wondering what a failed interest rate rise would look like.
Failed interest rate rise would be a circumstance where the increase in the discount rate or the increase in the Fed's fund rate led to an increase in the 30-year mortgage rate that slowed down home sales in the United States, or an increase in the 10-year Treasury rate that caused other bond market prices to fail, very much like what happened in the first stages of the Clinton administration. If the rise in interest rate rise in interest rates led to real calamity in the debt, equity, or mortgage markets, I think you'd see a failed interest rate hike, and I think that would be extremely significant for gold.
Okay, also on the topic of interest rates, you've spoken and other people have spoken about an interest rate rise being baked into the gold price. Can you talk a little about what that means?
I think Ms. Yellen has been pretty forthright about saying that she wants to raise interest rates and that an interest rate is coming. She has given financial interests a real opportunity to know that at least a quarter-point hike is coming. And I suspect that anybody who could read English has had the opportunity to factor in the impact of an interest rate in their investment decisions, be they bond investments, be they income equity investments, or be they gold investments.
So that about covers the U.S., I guess, but China is a very big factor in the market right now, as is Greece. How much attention should investors be paying to non-U.S. factors when they're thinking about the gold price?
I think non-U.S. factors are important, but I do think that the most important impact on gold is the U.S. dollar.
Okay.
Having said that, the expectations for all resource markets are driven by economic growth in China, and to the extent that economic growth in China is weak, demand across the board in resources is going to be weak. One further thing that I think investors in gold need to note is they pay way too much attention to the stated number of Chinese gold inventories. If the U.S. government won't release information or allow for an audit on its gold holdings, why would we expect the Chinese to be more transparent than we are? With regards to Greece, I see it as a non-event. The European banks managed to shed the liability from themselves onto the backs of the European taxpayers. And Greece's economy is about 3.5% of total Eurozone GDP. So I see it as symbolic. I see it as part of the narrative, but I don't see it as important as an absolute.
Okay. So heading back to that CNBC interview, you also said that a real run in the gold price could happen as early as Q4. To me, that sounds like quite a big if. So realistically, how hopeful should investors be about the gold price this year?
I don't think they should be particularly hopeful about the gold price this year. My own view is that gold trades contra to confidence in the U.S. dollar. And in investors' minds, they're completely calm about the U.S. dollar. A misplaced calmness, I believe, but that notwithstanding, a calmness. Gold doesn't need to win the war against the U.S. dollar. It needs to lose the war less badly. That's very, very important. But the truth is that the dollar has been very strong, perhaps as a consequence of weakness in other instruments. But until something happens to shake a little bit faith in the U.S. dollar, I suspect that the gold price will be in the doldrums.
So switching tactics a little bit, we're at your conference, and the companies here are all ones that Sprott likes. Do you have any particular favorites here today?
Well, I should say that they're all ones that Sprott owns. They aren't the only ones that Sprott owns, but we think that they were important for the audience that we've assembled here, which is a speculative audience. Certainly, the companies that have been in the news most recently, delivered the best news, would include Ivanhoe Mines, whose executive chairman, Robert Friedland, was a keynote speaker here. A little London-listed exploration company called Mariana Resources, which has been delivering spectacular drill results and been graded by real indifference by the market. And of course, Reservoir Minerals, which 2 weeks ago released one of the 10 best drill holes I've ever seen in my career. We think shares of Sprott Inc. the parent company of the company putting on this conference, at these share prices with this dividend level probably merits attention from investors too. But I'll tell you, Charlotte, I don't know if it's this year or next year. What I do know with regards to the junior resource sector is that the better companies in the sector will truly sparkle. This is my fourth major market cycle. And a market that's down by 90% in real terms is precisely 90% more attractive than it was at the top of the market when the narrative is possible. And many, many, many companies that you went past in that exhibit hall are going to evidence really outstanding performance in the next 5 years.
Now, those companies that we're looking at out there and that you like, they have probably, I'm guessing, good management in common. That's the thing people are often looking at. But in this downturn, you sometimes hear about talent shortages and things. Do you see that impacting companies at all?
There's always a shortage of good talent, but the truth is, if you look across the length and breadth of the TSXV, the 2,000 companies that inhabit the index, there's way too much management. There's always a shortage of good management. The challenge that the exploration and finance industries are going to have is really an age gap and a gender gap. Too much of the management team in the industry is my age. And strictly speaking, too much of it is male. We're beginning to address that. But if you look across other industries like finance, like technology, the middle management layers, the people who come to run those companies, are often 40 or 50% female. And I'm not saying this to pander to you. If you go through the middle suites in the mining industry and the oil and gas industry, it's still predominantly male, it's still predominantly Caucasian, and it's getting awfully old. And I think that's the problem we face.
Okay, all right. That's all my questions for today. Thanks so much for joining me. And this is Rick Rule, and again, I'm Charlotte McLeod with the Investing News Network.